What's up everybody, I am Jaspreet Singh, and dividend investing is considered like the holy grail of passive income because when you invest your money in dividends, what you're doing is you're investing your money in a company, and then the company is going to give you a share of their profits typically every 3 months, every quarter, and you don't have to do anything. Like if you invest your money in the McDonald's stock, the McDonald's company, now the company is going to work to continue to sell more burgers and open up more locations, and every quarter they're going to give you a check and you don't have to do anything except make sure that McDonald's doesn't go bankrupt. You can compare that to something like real estate investing, which is still kind of passive, but in order for it to really become passive for you as a real estate investor, you need to build up the right teams, you need to have a good property manager, you need to have good contractors, you need to have a good accountant. So real estate, while it can be passive, requires a whole lot more work to get there, versus stock market investing, not so much. That being said, there can be some major downfalls when investing your money in dividend paying stocks. Like if a company is paying out a dividend, that means they're going to have less profits to actually invest in their company, so you might see smaller growth in the actual stock itself, and you have the tax consequences of investing your money in dividends. So what I want to do today is really break down dividend investing, go over what it is, and go over some of the kind of not necessarily negative parts of dividend investing, but understand the cons of dividend investing. That way you can make better decisions for yourself as an investor and know all the ins and outs of really investing your money in dividends. There's 5 things that I want to go over today in this order. First, I'm going to go over briefly what dividends are, how dividends work, a brief 101 of dividend investing. Second, I want to go over the costs of paying out a dividend to companies and how that can affect your investment. Third, I want to talk about the costs of investing your money in a dividend stock for you as an investor versus investing your money into a non-dividend paying stock. What happens if a company doesn't pay out a dividend and they use that money to grow the company? How does it affect you and your taxes and your costs? Fourth, I want to go over if you want to invest your money in dividends, how do you do it smartly, get the best returns as an investor? And fifth, I want to go over some dividend paying companies and some dividend paying ETFs, and how do you find the right companies and investments as a dividend investor. So let's start by talking about number 1. But before we do, make sure you smash the thumbs up button below. When you take your money and you invest it into a stock on the stock market, whether it's Amazon or Lululemon or Apple or Tesla or McDonald's, when you do that, you become one of the owners of this company. And when you're one of the owners of these companies, you are entitled to your share of the profits. Now, there's a couple of different ways that you can get your share of the profits. One way is you can get your share of the profits from appreciation. Appreciation means the valuation of the company goes up, which makes their stock price go up. So if you buy a share of a company for $100, this company produces bigger profits, it becomes a more attractive investment, and then the share price goes up to $200. Now you have $100 worth of appreciation that you get if you sell the company, but you only get that appreciation if you actually sell the company. If you have that $200 sitting in your stock brokerage account and you don't sell it, well, it's not actual money in your pocket, because then if that stock goes down to $50 a share, well, you just lost all of that appreciation and you lost that $50 that you invested, because now you're down. But again, you don't actually lose money until you sell. So one way that you can make money and get your share of the profits is through appreciation. So if you invest your money in a good company, this company produces more products, produces more innovation, produces bigger profits, and it's an attractive investment, you can see your share price go up. And the second way that you can make money is through dividends. If a company has big profits at the end of the year, there are 3 things that they can do with this money. They can take this cash and reinvest it back into the company. They can take this cash and give it away to shareholders in the form of dividends, or they can take this cash and save it for an emergency. Now, a good company and a mature company is going to do all 3, and there are 2 ways going deeper into how do you actually give this money to a shareholder. One is through a dividend, which is a just cash check that they give you. Typically, these cash checks are given every 3 months, meaning every quarter. There are some exceptions to this. Some companies will pay every month, but most companies pay every quarter. So every 3 months, you get a check. But then there's another way that companies can also reward you by giving this money back to the shareholders, and that's by doing a share buyback. But I'll get to that a little bit later in this video. So when you're investing your money and you're getting dividends, you're investing your money for 3 reasons. First, you're investing your money for cash flow, because now you're getting paid without having to sell your stock, because if a company is paying out a dividend, now you're getting cash in your pocket and you don't have to sell any of your assets to get that. Second, you're getting your share of profits, because the only way that you can get a dividend is if a company pays out a profit. This is why you don't see a lot of the smaller startup and those momentum companies pay out dividends, because many of them are not profitable. They're investing so heavily in their growth that they don't want to have a profit. They want to invest every dollar that they can to get new users, to get new customers. They don't have a profit to give out to their investors, but more of the mature, older companies that have bigger profits can pay out dividends. So you get that through these dividends. And third is it's passive. Unlike real estate, where you have to own the property, you have to make sure that it's managed properly, you have to make sure you have the right team. With the stock market, you don't have to do any of that. I mean, sure, you can make voting decisions if you want to because you own shares of a company, but if you own thousands of dollars worth of a company or even hundreds of thousands of dollars worth of a company, your vote is pretty small. But you can vote. But your investment is very passive, because now you don't tell McDonald's what to do. You don't tell Amazon what to do. You don't have to go and flip burgers. You just get your share of the profits, and all you're really doing is monitoring your investments, meaning making sure that your company isn't going down the drain. The second thing that you want to understand about dividend investing, number 2 and number 3, I'm going to be talking about the cons of dividend investing, is the cost to a company. Now, the easiest way for me to explain this is by giving you a personal example. Now, the example that I'm going to give you is of my own company, but understand we are not a public company, but this will help you understand the cost of dividends to a company. So let's assume that my company, Market Briefs, makes $1 million worth of revenue over the year. And over the year, we also have expenses. We have to pay our writers, we have to pay our business development people, we have to pay our salaries, we have to pay our softwares. Let's assume that our costs to run the company are around $400,000 a year. This leaves a profit of around $600,000 in the bank account. Now, if this were a public company, this would then be valued and it would have a market capitalization. And to keep things super simple, I'm going to put a market capitalization of 10 times revenue, which is $10 million revenue. So the company is worth $10 million. Then you can divide that up into however many shares you want. That gives you the share price. It's generating $1 million a year. There's $600,000 worth of profit. Now, with the $600,000 worth of profit, again, like I said earlier, there's 3 things that I can do with this money. I'm gonna put this in blue. I can save this money in the business bank account in case we hit a pandemic and something happens and now we need cash to help run the company. Or I can use this money to invest it into growth. We can hire more people, we can do more advertising, we can do more things with the company to grow bigger, to go faster. Or I can do essentially a dividend, where now, assuming I'm the whole owner of the company, which I am at the time of me recording, I own the whole company, I can take the $600,000, put this cash in my pocket, and then I can go out and buy a nicer car. I can go out and maybe invest in real estate. I can go out and buy some Gucci or Louis Vuitton. I don't do that, but I could if I wanted to. I can take this cash, put it in my personal bank account, and then I can do whatever I want. There is a cost and benefit to each one of these, not for me personally, but for the company. Because now, if I take the $600,000 of profit out, I put it in my personal bank account, well, then the company is not going to be able to grow as fast as it would have if I took the $600,000 and then I reinvested it back into the company. Because if I take the $600,000, put it back into the company, we go out and do more advertising, we do more marketing, we hire more people, then maybe next year our revenue can grow from $1 million to $2 million because we're taking all of our profits and reinvesting it back into the company. If it grows to $2 million, then the market capitalization would then go to $20 million. Assuming that it still has the same valuation. So if you own stock in this company, your stock would double because then we can work to grow the company even though my profits are smaller. But if I take all this cash and I put it in a dividend, I pay it to myself, well then I don't have the $600,000 in the company to go out and grow the company. Now the company just has to grow in whatever organic fashion that it does. Maybe it only grows to $1.1 million next year, which means that your stock will only grow by 10%, but the owners, in this case me, gets a dividend. It gets cash in my pocket. So this cash in my pocket goes to the owners of the company, but it doesn't help grow the company itself. So it doesn't really help grow the stock price. However, it does help the investors because now you get cash in your pocket. If you're investing the money back in the company, well, that does more for the company, for the share price, because then it makes the valuation more attractive because now the company is working to grow the revenue, is working to grow the profits, and that can help grow the valuation of the company. And then you also have this side, which often gets overlooked, which is saving money in the company. Now, the interesting thing here about saving money is it's not attractive to an investor. Because if a company has $10 million or $100 million on their balance sheet, that's money that's just losing value to inflation. It's not doing anything. It's real valuable when the cash gets put to work. If the cash is used to help invest back into the company, open new stores, hire more people, grow the company, or the cash can become attractive if you use it to go out and buy another company. But generally, to an investor, the saving isn't very good. However, it is good for the company when things go wrong because then this company can be sustainable. We saw the effects of this in the 2020 pandemic because so many companies didn't have the cash to go through 2 rounds of payroll without having to go into debt or without going into bankruptcy. So there's value of savings, but again, the company has to match this balance with how fast do they want to grow the market capitalization of a company. So if there's one concept that you can really get out of this entire video, it's understanding this, that when a company pays out a dividend, you have to understand what that means to the company because that means the company is going to have less cash to grow the company quicker. However, it's still good for the owner, the shareholder, because now you get your cash in your pocket. So it's a little bit of a safer investment for you. However, you can expect your stock price to grow less quickly because less money is going back into the company. That's why many times the companies that pay out these dividends are the ones that are much bigger, the ones that are much more mature, because they just don't have a place to put this cash. They're so big, they're so large that they can't invest all this cash back into their pocket because they just don't have a way to do that. They can't grow that big. So now that's why they're paying out some of this cash to their shareholders as a dividend. So you want to understand that and what this means for your investment, because you have to understand your goal will not be to see the max stock price appreciation, is to get steady cash flow. The third point that you have to understand about dividend investing has to do with the cost to you as an investor, which means, well, taxes. So let's go back to that example that I just gave you a minute ago. Company makes $1 million and then it has $400,000 worth of expenses, leaving it with $600,000 worth of profit. Now, this is the money that the company can pay out in the form of dividends, but the company can't pay out all $600,000 worth of profit because when you have a profit, you got to pay taxes on that. The government wants their share of the money. So the first thing that's going to happen before they can pay out a penny in dividends now, assuming that they're going to pay out a dividend, is now you have to pay taxes. The company has to pay taxes on this money, and let's assume for the purposes of this video that the company is going to pay a tax rate of 20%. Now, this is where if it's a bigger corporation, they're going to have that lower corporate tax rate, somewhere between 21% and 28%, depending on which bills get approved and not approved. But that's kind of the general area of where this corporate taxes are. Now, just for your own understanding, companies don't always pay that full corporate tax amount because they're going to take deductions and other expenses and that they're going to take on their taxes. So they don't typically pay the full amount, but let's assume that they have to pay 20% of this profit in taxes for rough numbers, which means they're going to pay another $120,000 in taxes right here, which leaves $480,000 in profit. I'm doing all of these numbers right in the board in front of you, so if I make a mistake, I apologize. But $480,000 worth of profit, which they can then distribute to you as the shareholder. So I'm going to take this up here. So now I'm going to draw you with a nice mustache, and for our female followers, I'm going to draw you a nice braid. In my native language, Punjabi, we call a mustache a much, we call a braid a gut. So now this $480,000 worth of profit gets distributed to the shareholders, and now you get this cash in your pocket and you're very happy, you're smiling, but now you got $480,000 in your pocket, and I'm assuming that all this cash is going to you. It's going to be distributed by each share, but it gets distributed, but then you have to pay taxes. You have to pay taxes on your individual tax return because you just got cash in your pocket. As soon as you get that dividend income, you have to pay taxes because that money hits your bank account. Even if you reinvest that dividend income back into the company, you have to pay taxes on your dividend profits. So now, you assume that you got $480,000 here. Now you are going to have to pay taxes on your dividend income again. Now you're going to say, but the money was just taxed. And you're right. This is why big corporations are known as doubled taxed entities, because you have to pay taxes on your profits, and then you have to pay taxes when the profits are distributed as well. So this $480,000 that gets distributed is already taxed income, but once it hits your personal bank account, when you are the owner of the company, then you have to pay taxes on this income again. Now, the good news here at the time of me recording this video is that this dividend income that you're getting is taxed at a lower tax rate than the income that you get from your job. So the income you get from your job is called ordinary income, and that's typically taxed at the highest tax rates that a tax code has to offer. Dividend income gets a special tax rate, and this typically ranges between 0 to 20%. At the time of me recording this video, just understand that this can change because there are some bills being proposed to raise these tax rates, but right now it's between 0 to 20%, depending on your income, depending on how much cash flow you're getting. So if you get $480,000 worth of dividend income, well, assuming that you have to pay the top tax rate of 20%, that's another, $96,000 that you have to pay in taxes, which means that after all this is said and done, you will get left, I'm gonna put this right here, with $384,000 of cash flow in dividends. So you went from $600,000 worth of profit after the first layer of taxes, after the second layer of taxes, left with $384,000. So a big chunk of this money goes to the government in the form of taxes, but then the remainder can then go out to the shareholders. So the second con that I want to talk about, which is point number 3, is the cost to investors, because now when a company takes this cash and they pay it out to shareholders, owners, people like you, well, then not only does the corporation have to pay taxes, and then you also have to pay taxes, versus more of this money potentially going to increase the share price. Again, because if this cash was used in the company, well, then the taxable income goes down because now your profit goes down. Because if, in the previous example, if I spent all $600,000 in the company, if we had all $600,000 go into helping to grow the company, there's $0 of profit, so $0 of taxable income, more money growing to grow the revenue, to hopefully grow the future profits, which can help grow your share price. But here, the company has grown so big that they don't know what else to do with these profits, so they pay it out. So you have a cost as you, the shareholder, where now you got to pay taxes here, and it's not you paying the taxes, it's the corporation, but the corporation is owned by you, so you're kind of indirectly paying it here. You're indirectly paying the taxes here, and then you're directly paying the taxes here on your personal level. The last thing that I want to say here before we move on to number 4 is that there are some exceptions here where you don't get these lower tax rates as an investor, as a shareholder, depending on what kind of dividends that you're getting. So if you have specific tax questions and you want to see if you do qualify for these lower tax rates, make sure you talk to a tax advisor, because although I am a licensed attorney, I'm not your attorney. So talk to a tax professional if you have tax questions. By the way, these taxes are also why some investors prefer buybacks instead of dividends when a company is rewarding their shareholders, because when you do dividends, the company has to pay taxes here, and then you have to pay taxes here because you're getting this cash in your pocket. But when you do a share buyback, there is a special tax rate that the corporation pays here, and then you don't have to pay any taxes here because, well, you don't get any income. The share price that you own will appreciate, which means you have a bigger income on paper, but it's not actual income because you haven't taken any of this money out. And then there are other loopholes that you can do to access this money without having to pay taxes. Like you can use debt to borrow against your assets. That way you don't have to pay any taxes yet. And then you could potentially just keep borrowing money until you die. That way you never have to pay taxes on the income. So there are some reasons why investors would prefer buybacks over dividends. But dividends give you cash in your pocket today. The expense that you have to pay for getting this cash in your pocket today is taxes. The fourth thing, now that we're moving past the cons to understand how you can actually be a dividend investor smartly, is understanding, well, how do you be a smart dividend investor? And there's 3 things that you want to understand here. First is there's a lot of advantages when you can find dividend stocks at a lower price, because if you can find dividend companies, and you can, buy low, sell high, but if you can find them at a lower price, you can get benefits 2 ways. So let me give you an example. Let's assume that you can find a dividend company that's on sale and it's trading for $100 a share, and they pay out a $3 annual dividend. So they're paying a 3% annual dividend. and then the company price goes up because you were able to get it at a discount. So now this company is innovating, they're able to make more profits, and the share price goes up. And for the purposes of this video, let's assume that it doubles in price. So now it goes up to $200 a share. On one hand, your stock investment is a lot more valuable because your stock investment doubled. But then the company might also increase their dividends to make up for this higher share price as well, because now the dividend percentage has fallen to just 1.5%, because $3 of a $100 share price is a 3% dividend, and $3 to a $200 share price is a 1.5% dividend. So if a company's profits are growing incrementally and they're seeing bigger cash flows and they have this cash to give out bigger dividends, then what they might do is they might also double their dividend. So now you bought in here. You were getting $3 a share, but now your stock price has doubled. So if you look at your stock brokerage account, you're going to see a bigger number there. Your amount has doubled. If you invested $10,000, now it's $20,000. But now your cash flow also doubled because you're increasing the amount of dividends that you're getting. And you can see a bigger increase here, assuming that the profits go up. But this is where it gets even more interesting, because this is just assuming that the company isn't paying out a bigger share of their profits and dividends, because what a company could potentially do is say, well, we are so much bigger now, we have less room for investment in our companies. We actually want to increase our dividends to $7 a share, because now they have bigger cash flows and they don't have other places to put it. So if you're able to buy low, get into these companies earlier on, you can see bigger benefit in the dividend amount that you're getting. So now your cash flows are increasing every single year in addition to the actual value of your companies. So now you can win two ways. But in order for you to be successful here, you have to know how to research, because the mistake that so many people make, and it's the mistake that I made myself too, is you invest based off of this. You look at how much dividends a company is paying and you see how attractive the investment is. You might see a company that's trading for $100 a share that's paying out a $9 annual dividend. And you might say, holy moly, $9 a year, that's a 9% annual dividend. That's a great investment. And then you come in and buy. But what you might not see is that just a little while ago, the company was trading for $300. Sorry, you can't see it. $300 a share. So if the company has lost more than half of its market value, and the reason why it's losing is because it's on the verge of bankruptcy, and then you come in and buy because they haven't adjusted the dividend yet, you're just trying to catch a falling knife, but the knife is going straight down to the ground because you didn't do your research. That's why you do not want to make your investment decision solely here based off of the dividend. You want to make your investment decision based off of the company. How good is the company? How strong is the company? How innovative is the company? Do you like the company? If those are all there and they pay a dividend, that would be a reason why you want to invest. You do not. I'm going to repeat this again because this is so important. So many newer investors, especially when it comes to dividends, make this mistake. They look only at the dividend percentage and they just want to invest their money into a higher dividend because it's higher cash flow. That is a huge mistake. You do not want to be doing that, because if that's how you're investing your money, you are at huge risk, because then you could be one of the people that's investing your money into a very volatile company or into a company that's on its way down, because companies can also cut their dividends. Here we talked about a company raising their dividends because they're growing, they're more innovative, they're creating more products. But if a company is doing the opposite because they didn't do your research, well, then they could be cutting their dividends. The share price is going down, they're cutting their dividends, they're getting rid of them, and that makes the stock less attractive, which can also put the share price even lower. So it could be a more positive spiral or a negative spiral, but in order for you to make a good investment, it requires you to do your own research. Now I'm going to talk about how do you find good dividend companies and dividend ETFs in number 5, but if you want to know how do you actually research this, this is where your stock market education, your financial education comes into play. If you're looking for some extra coaching on how to do this, you can check out Market Insiders. It's an investing education app that I created where every week you get access to coaching sessions in the stock market, the real estate market, and the cryptocurrency market. These are real life investors, people who have invested hundreds of thousands, if not millions of dollars of their own money, who are giving you coaching lessons every week. So if you want to try out Market Insiders, I'll give you a free 10-day trial for you to go through the whole thing, see if it's right for you or not. And if you want to try it out, I'll put the link for you down in the description below. And the last thing that I want to mention about being a smart dividend investor is understanding how do you now stack your cash flow. Because if you're looking at this and you're saying, all right, Jaspreet, this is cool and all, I understand the costs, I understand the cons, but I still like the idea of dividend investing, and I just want to build this passive cash flow machine that's paying me every single year that I can live off of, great. but the way that you can get there faster is by following something called DRIP, the Dividend Reinvestment Plan, which says that now when you get paid a dividend by a company, instead of you taking this cash, going out and buying something nice, you're taking this cash and using it to buy more shares of the company. That way, every single time you get dividends, you get more and more dividends, because anytime you get paid, you're buying more shares of the stock that's paying you. You get paid some more, now you use this cash to buy more shares of the stock that's paying you. So it's kind of like buying a machine. So you buy this asset that pays you with cash flow. Now, anytime you get cash flow, you buy more of the machine that pays you with more cash flow. Now you get more cash flow and you start buying more of this. That way you can get even more cash flow. And you keep doing this again and again and again. And over a number of years, what you'll see is that your cash flow will just keep racking up. And it's like the snowball. It gets bigger and bigger and bigger. And initially, the first couple of years, you're not going to see a massive increase, but it starts to get bigger and bigger and bigger over time, because the way that this works is now you're going to keep using your own income that you're getting from your job or your business or whatever to keep buying more shares of this company. And then anytime you get paid a dividend, you're also going to use this dividend to buy more shares of the company. So you're buying more share of this income producing machine, and you want to do this as fast as possible. That's why you keep putting more of your own money and you keep reinvesting your money into it. That way this machine can keep paying you more and more and more dividends. That way you can build a passive income machine, but it requires you to do that research. And if you can do this, that's how you can get the biggest returns. And this brings me to number 5. How do you find good dividend paying companies? The first thing that you have to understand if you want to find good dividend paying companies is how do you find a company that's paying a dividend or not? And the easiest way to do that is by going to a stock research website. So you can go to Yahoo Finance, you can go to Seeking Alpha. There's a ton of them out there. Find whichever one you like. And so then when you go there and you research a company, you enter in the stock ticker symbol, they will show you if the company is paying out a dividend. Like for example, at the time we're recording, McDonald's is paying out a dividend, and you will see that they have a dividend yield there. That means that they're paying out a dividend. And right now Tesla is not paying a dividend. So if you search Tesla, you'll see that right now it's say NA. That means that they're not paying out a dividend right now. So that's the easiest way to see if a company is paying out a dividend or not. Now the question is, how do you actually decide if a company is paying out a good dividend and if it's a good dividend coming company or not? Now I'm going to oversimplify this because there's really an infinite amount of research that you can do here to see if a company is a good company or not. But the two things that I want to focus on for the purposes of the dividend are you want to look at the profits and you want to look at dividends. Now again, any of the stock research companies will be able to provide you this information, but the first thing that you want to look at are profits, and more specifically profit growth, because you want to invest in your company that is growing, that's not dying. And the way that you can see that in a dividend paying company is you want to be looking at profit, and more specifically profit growth. So you want to look at the last 3 years, look at the last 5 years, see what's been going on with their profits. Have their profits been growing consistently? And then the second thing that you want to look at are the actual dividends and the dividend growth. Now again, any of these stock market research websites will be able to provide you this information where you can just go look into the historical dividend data. Then you want to see what's been going on with their dividends. Have they been paying the same amount of dividends for the last number of years? Have they been cutting their dividends over the last number of years? Or have they been increasing their dividends for the last number of years? Now, of course, past performance cannot predict or guarantee future performance, but what you want to see, especially in a stable dividend paying company, is you want to see dividend growth, because what you want to see is a company that's been working to increase profits, that's working to increase dividends, because that's the type of investors that they're attracting, that they've been increasing their dividends for a number of years. So that's the company that you should be interested in if that's what you're looking for as a dividend investor. So you find a list of dividend paying companies, and there are so many lists out there that are current right now. Go onto Google, search 10 best dividend paying companies right now, read 10 of the top articles, and then you can put together a list of dividend paying companies that are interesting. Then you start doing your fundamental analysis. You see if the company is good, you like the company, you like the products, are they innovating? And then you start doing that dividend analysis. You start looking at the profits and the profit growth, and you start doing the dividends and you look at the dividend growth, and now you can compile a list of dividend paying companies that you would be interested in investing in. Now, if you're looking at this and you're saying, okay, I don't like this type of analysis, I don't want to do this type of fundamental analysis, is there any other way for me to invest in dividend paying companies without putting in all this work? And the answer is yes. And the way that you do that is by investing your money in an ETF. An ETF is an exchange traded fund that gives you exposure to a basket of stocks, a group of companies, instead of just one company. That way now you don't have to worry about doing all this research. And there are ETFs that are made specifically to invest in high dividend paying companies. One example of this is is VYM. This is the Vanguard High Dividend ETF. And I'm not telling you what to invest in, just giving you an example because Vanguard is a reputable company that creates these type of ETFs. VYM is an ETF, and this invests into a basket of around 440 or so dividend paying companies. So now instead of you trying to invest in all these companies, this ETF invests in 400 to 40 of these companies. If one of these companies goes bankrupt and it falls out of the list, well then it kicks that company out and it'll put another company in. So this is another way for you to get exposure to the dividends. At the time we were recording this video, VYM is paying something like 2.8% or so annual dividend a year. And so this is kind of the returns that you can expect if you're investing in ETF. Obviously, if you invest your money into individual companies, you can get potentially higher cash flow from your dividends. But again, risk return. With an ETF, you have lower risk and lower potential return. The reason why you have lower risk is because you're not investing in one company. You're investing into hundreds of companies. But if you're investing your money into one company, well, then you have more risk, but also the chance for higher potential return. Now, at the end of the day, if you want to be a successful and a profitable dividend investor, that requires a few things. One, you have to be a long-term investor, which means you're not just investing your money for 6 months. Two, you have to be a consistent investor, which means that you're not just investing your money into these dividend companies once. You want to keep investing your money consistently again and again and again. And then third, you want to be investing your profits back into your dividends. That way you can grow this machine faster and bigger. If you want to dive deeper into dividends, I outlined a plan on how you can generate $2,000 a month from your dividend portfolio, and you can watch that video by clicking this button right over here. Thank you for watching, and as always, keep hustling. Important to not just blindly throw your money into a company that pays out a dividend. You need to do the fundamental research. That way you can invest your money into a company